All right, everything looking good. We are live. Let's go ahead and do the damn thing. Welcome back to the channel, Crypto Trend Trader, with our Friday morning market wrap up. It is 11 a.m. Eastern Standard Time on 7/8/2022. And like always, before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so we are seeing a lot of the plays, a lot of the trade setups, a lot of the potential moves we had scoped out in advance are playing out beautifully. So let's go ahead and take a look at what these markets are telling us. And we got a couple of things on the radar as we are seeing some. Now, obviously, we don't want to get too excited about anything. But the truth is, we're seeing a couple setups that are looking pretty nice. We're also seeing some indications that, contrary to popular belief, there may be some serious opportunities in the near future. Now, the important thing about an inflection point or these key areas, zones, or time periods that we watch for is that we don't have a bias one way or the other. And even if we do have a bias, we don't let that affect our trading. And right now, if you haven't noticed yourself, what I'm actually referring to is China. We are seeing, obviously, news and lockdowns and, Rona issues and, all that kind of junk still going on over there. But the charts are telling us a different story. Now, again, the thing about an inflection point is when you're in a bear market for a long period of time and then you reach one of these inflection points, there's a possibility, obviously, that you just get rejected and go back into the bear market and see continuation. But also, there's a possibility that we start to confirm back into a bull market, or at least like neutral, and then the possibility to the upside is, really endless. Because assuming that, let's just say, for instance, that, we come down, go into a bear market, rally back up eventually, back into a bull market, and then we see continuation. It's not unrealistic to think that eventually you're going to put in a new all-time high once you see continuation out of that bear market. Now, of course, it's possible we get rejected again and go back into a deeper bear market, a deeper recession or depression or, whatever else. But regardless of what we think is going to happen, we have to respect what the charts are telling us. And the charts are telling us we're at an inflection point. So we're going to take a look at China, a couple of big names today. Obviously going to take a look at our main indexes. We'll look at TNX. We will look at the 11 sectors of the United States stock market, DXY. Talk a little bit about that as we did hit another one of our targets and could definitely see some short-term pullbacks. We talk about our metals and how that could affect them. And obviously upcoming Fed meeting. And then we'll do our cryptocurrencies and a couple commodities as well. So let's go ahead and jump right in and get started here. What's up, Unique? Good afternoon to you as well. Honkiness, what's up, brother? Good morning to you. So yeah, let's go ahead and take a look at some of these charts. So just starting with TNX. We see over the last couple of days, TNX has rallied back above the 8 and 21. A weekly close above this level right here basically says that, like we discussed, we did not take out that previous low. And by not taking out that previous low, obviously we have a higher low. And, if we have a higher low, we also have some bullish divergence on the TDMACD and, potential that we're headed up to new highs. We also got our Fed minutes. Sounds to me like the Fed is still confident. And I don't see anything in the numbers telling me that we're going to see anything less than a 75 basis point hike. You're saying no sound? Really? Everything's showing up on my end coming out okay. Can someone else verify if there is sound or not? Yeah, I'm not sure. It looks like on my end we have sound. Testing, testing. 1, 2, 3. Somebody let me know if there's sound. Obviously, if you guys can't hear me, you don't know. Sound is perfect. Yeah, honkiness. Check your speakers or something, man. I'm not sure what to tell you. Okay, appreciate you guys. Thank you, Bullies. Appreciate that. So yeah, let's keep going. Check your sound, man. You might be muted or something. So anyway, that being said, what we're seeing right here, indication that we're about to get another 75 basis point hike at the end of the month. That tells me that, more realistic than not, TNX is going to be heading higher. Obviously, if we flip over to TLT, the actual Treasury 20-year, what do we see right here? Well, it looks like we basically popped up. We confirmed the 821 cross, and then it's getting rejected now, and we're crossing back to the downside. We also used up all our energy on that little pathetic move back to the upside. All the bond bulls, all the, failure technical analysts who have been calling for, basically a bottom on bonds this whole time as it just completely melts down and they lose, hundreds of millions, billions of clients' money. I mean, the bond market has literally wiped out multiple trillions of dollars in the last few months. And what does it look like when we really zoom out and look at it? It looks like a break. It looks like a retest of the breakdown. And then it looks like we're going to get continuation. So I don't know what these bond people are seeing. I mean, obviously they're trying to trade with their hearts and not with their brains because this is a disgusting, disgusting chart. I mean, this to me, when I see this, it literally, I throw up in my mouth a little bit and then I have to swallow it and just go about my business. Because that's how disgusting this is. I mean, this is a push back up to resistance, exactly what was support, a rejection, and now we're getting a massive sell-off. So, the week's not over yet. We still have the rest of the day today. We had some bullish divergence on different time frames as well. But we know bullish divergence, when it's counter trend, when it plays out, it typically underperforms. So that's what we're seeing, an underperformance back to resistance and then rejection, likely to see continuation to the downside, still very much in a bear market. Losing the 200 exponential and simple. I mean, look at the beginning of this monthly candle. Who's buying into this monthly candle? I mean, you have got to be an absolute moron to look at this chart right now and say, this looks like a good buying opportunity. I mean, I don't care. Go ahead, lose all your money. All this tells me is 40-year bond bull market. And I mean, pretty clearly, I would call this, a blow off top. I mean, this is absolutely disgusting. So for me, I mean, I don't know. I'm using the technicals. And then also, you can use fundamentals, you can use your brain, but bond market looks absolutely disgusting to me. So, I understand you can sit here and create a case for anything. I mean, part of debating and just intelligence and general knowledge is the ability to take either side of an argument. So it doesn't matter what the topic is. One thing I pride myself on is being able to debate people. So if you're educated in a topic, even if you don't agree with the side that you're going to take, you could debate the other side because you have enough general knowledge to say, okay, I'll take the other side of that. I'll take, of socialism or, whatever, conservative. Like, you can debate any side of any argument if you're just educated on that topic and good at debating, making a case for something. And that's very important, I think. Now, for something like bonds, sure, I could debate. We can make a strong case for why bonds are a good investment. But, also the obvious case is that they're trash. They were in a 40-year bull market and now they're not. They're confirming into, potential bear market now. So I don't know. I mean, for 40 years, you could literally just say whatever you wanted and be right as long as you were a bond bull. So now the 40 years is up. We're at that point in time where it's like, hey, maybe all of a sudden bond bull market's not a thing anymore. I mean, look at this weekly chart. Does this look like a fucking bond bull market to you? Or does this look like we just confirmed into a weekly bond bear market? Because that's what it looks like to me. But also, I'm not biased. I mean, I don't really give a shit. I like when things are in bull markets. So right now we see the most disgusting beginning of a bear. I mean, this is a bull market from 2006. And we have one time where, we get a little flip here, a little flip there, a little flip here, a little flip there. Right here, we confirm into a bear market in 2018. Okay, it doesn't last that long. And look at how pathetic this little bear market is. I mean, we basically retest, and then we have a small drop from when we close below the 200 exponential. 8%. Okay, so now let's look over here. Now, does this look like just a little hint, just a little taste of a downtrend? Or does this look like a complete fucking meltdown? 20% since we broke through the 200 exponential and simple. And I get it. People are like, oh, I'll just buy the dip. I'm going to buy the dip because it's worked every time for the last 40 years. We'll just buy the bond market dip. Well, I don't see any other times when the bond market was down 37%. And especially not in like a, 1 to 2 year period. So maybe something's different right here. I don't get it. I don't understand. No, I do get it. I do get it. I know exactly what it is. When you've been doing something for 40 years and you've been just mindlessly betting in one direction nonstop and been right, you think you're actually good at something, but in all actuality, you're just trend trading, which is fine. That's what this channel is all about, trading with the trend. But the problem is, and the reason all these people get wiped out, and the reason they're going to wipe out you, and they're going to wipe out all of your, investments, they're going to wipe out your portfolio, is because they can't recognize when things have changed. So for me, when I see something like this, when I see a break below the 200 exponential, when I see the 200 monthly simple moving average flat, and I mean, this is flat. If it literally cannot have any less slope on it, right now it's straight flat. If it has any less slope, any negative slope, it's going to confirm the 200 simple is going to flip pink. And then the 200 exponential and the 200 simple will be red. And we'll see, obviously, the 200 exponential and simple only go back so far on months on this chart because it goes back to 2003. We don't actually get a populated moving average until 2019. So there's 16 years of price action without a populated moving average. But I mean, we could probably figure it out. It probably looks something similar to, our parabolic trend line or the bottom of the channel, something like that. I mean, we can imagine, without being like too creative here, that essentially these 200 moving averages probably look something like this going back in time. So we have literally never been below them, definitely not have a negative slope on them. And then obviously we know this bond market has been going on since, essentially like the late 80s. So that being said, we're seeing things in these markets similar to the things that were taking place in the late 80s, which was after, a decade of extended entrenched inflation that led to, basically, I mean, look, we've been through this 100 times. I don't want to be too repetitive for you guys, but let's be real here. Anyone can look at this chart and say, hey, hang on, we might not go into a monthly bear market on bonds, but it sure looks like there's a threat of it happening. And if there's a threat of it happening and people are saying we should be buying the dip right now, maybe they'll be right. And this will be the best buying opportunity ever. Or maybe this is the change in trend and all these people are about to get wiped out because maybe we go into a 10-year bond bear market or 3-year bond bear market, or who knows. And again, we can come up with all kinds of fundamentals. I can argue why there's going to be inflows to the dollar and bonds. I can argue why there's going to be outflows to the dollar and bonds. And then we can sit here and fight and talk about, which one's going to win, because it's a tug of war. Inflows and outflows, safety trade and longevity versus, uncertainty, etc. But the fact of the matter is, we can look right at this chart and you can literally just look right here and say, hang on, this is an inflection point. We are for sure about to do one of two things. We're either going to enter into a bond bear market on the monthly and shit's going to hit the fan because the bond market is exponentially larger than the stock market. And we're talking about trillions and trillions of dollars of potential wealth destruction. Or we're going to find support around this level, which we've already broke down below multiple months now. And we even closed, opened, and now, potentially at the end of this month, if we don't get back above 116, we'll be closing below the 200 simple and confirming into that bear market. So one of two things is going to happen. We're at an inflection point in the bond market. The bond market's either going to melt down for an extended period of time and destroy more wealth than ever historically has been destroyed, or we're going to find support around this level, rally back up. And it's real easy to tell which one's going to happen. I mean, if something really good doesn't happen in the next 3 weeks, we're confirming into a bond bear market and we're going to see a meltdown. And then in order for the bond market to reverse and look good again, we know exactly what has to happen. We have to pump back up. We have to start closing back above like 117. Easy. Super easy. So we know exactly where to watch. We know exactly what's going to tell us. Either of those things. Start closing back above here. Oh, neutral bullish. We don't. Fucking bearish as hell. So, we'll see what happens. Am I buying the dip on bonds? No. In the words of Peter Stiff, bonds are basically reward-free risk. You take all the risk and you have nothing to gain from it. What are you going to gain? You're going to lose buying power for sure. And you're going to take a bunch of risk to your, principal, speculating obviously. So, if I told you, hey, I'll loan you, you know, $1,000 right now, and then, you know, you give it back to me in 2 years, 5 years, 10 years. And when you give it back to me, that same $1,000 after inflation is going to buy me $500 worth of stuff, but you're going to pay me 3% per year. I mean, is that a good deal? No, that's a terrible, terrible deal, you know, in real purchasing power. So that being said, I don't see what these people are looking at, especially when the Fed is sitting here telling us we're about to get another 75 basis point hike, all this stuff. So regardless, you know, that's just me though. I'm just using technical. So what do I know? We'll see. But I mean, I'm hearing so much talk about how bonds are looking appealing now, and this is the bond opportunity of a lifetime. I mean, bonds are dead, in my opinion. So that being said, let's look at the VIX. So what's the VIX telling us? Well, we're still operating inside that triangle. We've been operating inside the triangle. We expect it to come down here to the bottom of the triangle. The bottom of the triangle corresponds with our ascending channel. It also corresponds with 200 exponential and simple. We're down at the bottom of the range. So one of two things is going to happen now. We're either going to find some support around this area and move back to the top of the channel. We're going to see volatility pick back up and probably a sell-off in the stock market. Or we're going to break down from this level. We're going to confirm the breakdown. Volatility is going to go back down and everything's going to be peachy again. Now, we don't know which one's going to happen, but let's be real here. We can assume, and we'll be right 90% of the times, that every time we come down to the bottom of the range, it acts as support. And every time we come to the top of the range, it's going to act as resistance. And why is that? Because we're in a trading range. We're in a tightening trading range. Now, one time it's going to break, and we'll be wrong if we assume support at the bottom and resistance at the top every time. But how many times already would we have succeeded? Well, you know, arguably, depending when we started drawing the channel in here, you know, let's say right here and right here. So we came down to support here. It was a buying opportunity. Come up to resistance after seeing these two, you know, and then also our channel here. It was a selling opportunity. Buying opportunity, selling opportunity, buying opportunity, selling opportunity. I would say buying opportunity. Is this going to be the one time we're wrong? I mean, sure, maybe. Or maybe it'll just move right back up here and then we'll get to another selling opportunity, then a buying opportunity, then a selling opportunity, and then eventually we'll break. You know, reason tells me that volatility probably breaks to the upside and that we're probably getting to, you know, the lows and we can expect the market to sell back off. Now, we can look at the market and see, you know, we can look at the S&P, the Dow, the NASDAQ, some of these other major indexes and see, hey, are they looking kind of toppy right now, or they look like they can just rip to the upside? And then we can get a little bit of confluence from that. So next we have oil. Obviously, oil came down to support, tagged the 200 exponential perfectly, tagged the bottom of the channel perfectly, and now we push back up to our target. So we broke down from support, which was the heart line of the channel. You know, after retesting the top, we found support again, lower high. So a series of lower highs and lower lows. Obviously, we came all the way back down, retested the bottom of the range, and then the next move to the upside is a retest of the heart line, which we did. So now the real question is now, when we close right here, let's say roughly around this level, we're below the heart line support. And typically, when we're going to get a break in one direction, what happens is you move to that support level or resistance level, you back test the heart line of that channel, and then you move back down to that support level again, and then you get a break. Now, it doesn't have to happen like that. We could easily move back up to the top of the range. Still massively bullish on energy, oil in general, long term. But right now, I think that this is tired. And what we're seeing, multiple different iterations of, basically have a high, a low, a lower high, a lower low. We have a downtrend from right here. And then if we take this macro peak and this macro peak, we have a high, we have a lower high. So we have a downtrend from here. The only thing we're waiting to see basically is we have essentially a high, then we have a low, then we have a lower high, and now we still have technically a higher low, but you know, we're just in the middle of coming down here and threatening this low. So we have a downtrend, and then the real question is, if we take out that low, if we take out this support in yellow right here at 95, you know, then we confirm a macro downtrend, a peak, and then we can start really looking. Now, obviously the indicator oscillators are down towards the bottom of the range. Depending on what time frame we're looking at, we have 200 exponential and simple for support. We have the bottom of the channel for support. It's going to be tough to break through here, but it's going to look very clear if we do break down from this level, or when, or you know, eventually if we break down from this level, it's going to look very clear like longer term distribution is taking place. Now, we don't know that until it's over, and a lot of times people will say, well, no, that's reaccumulation. And you say, well, no, it's distribution. And then only one of you is going to be right. So the key is to be able to recognize the difference, and that's what our static video series coming up is all about, recognizing the difference between distribution, accumulation, redistribution, reaccumulation, and then also some other key chart patterns, etc. And then we're going to be doing a deep dive on divergence and how to recognize divergence as well. So, okay, cool. You got it sorted, brother. I appreciate everybody that chimed in about the volume. Glad you got it sorted, hunkiness. I appreciate you guys helping out there. So yeah, that being said, we're still looking at that oil chart. We know what to look at. We're obviously at some key levels. Those levels, oil has been trading very, very technically. I mean, absolutely beautifully. So no reason to think it's going to stop. All right, so let's look at our major indexes. So here we have the Dow Jones. We know obviously we bounced key support levels. We're back testing, you know, what was support as resistance. We're close to confirming an 821 cross to the upside, the first step that we need to see before this starts to move up. We're starting to build some momentum on the TDMACD. We obviously have a positive bull stochastic cross moving back towards the upside. So what's really going on here? We're in a bear market. We have a high, a low, a lower high, a lower low, a lower high, a lower low. So what needs to happen for this to change? Because we just assume at this point in time we're going to keep going down because we're in a bear market and it's weak. So that being said, in order to change, in order for this to look bullish, we need to take out this high. So we need to come all the way back up to 33,200, back test the 200 exponential and simple, and then we can start looking at it and saying, okay, there's a possibility actually that we're going to retest the 200 exponential and simple, consolidate, take out this high, start to put in, you know, now we have a low, then a, you know, potentially higher high from this high, then we come back down, put in another higher low, and then we can start building positivity to the upside. Now, do I think that's going to happen? No, of course not. I mean, because, you know, we're in a downtrend. We continue in the downtrend until we don't, most likely. It looks really just like we're seeing the exact move we talked about, which is basically the push back up to retest the 8 and then potentially a push back down to the 200 simple. And that's our weekly. And then when we look at the monthly, this is the move we were talking about the whole time since before that monthly close came in. And we said there's a nasty, disgusting monthly close. Likely the next thing that happens is everybody gets very bearish, starts talking very bearish. And then in actuality, what happens is price action comes all the way back up, back test the 821 at about 32,500. And then we can decide from there. Do we get rejected and go lower? Do we break back above it, confirm to the upside and go higher? We don't know what's going to happen. I would say my bias is to the downside, as I don't see anything in these markets that all of a sudden tells me to get bullish. But, you know, I'm open to it. I'm ready for it. I'm looking forward to it. I would absolutely love for all these markets to just flip bullish again and just go into some, you know, retarded parabolic uptrend, melt up. Because life is just so easy. You just make a ton of money and you do no work. That's awesome. Let's do it. But that's not what I'm seeing. So that being said, looking at SPY, again, same thing, back testing resistance, using a lot of energy to get all the way back up to these levels. We're actually seeing some bullish divergence on SPY that we don't see on the Dow Jones. When we zoom out to the weekly, again, seeing the exact move we were talking about playing out, the dead cat bounce off the 200 exponential, the back test of the 8 until we can close back above the 8 on the weekly. Nothing to get excited about. Obviously, the most likely move, short to medium term, is actually a test of the 200 simple at about 352. So that is what I'm expecting. Obviously, that does not have to be the case. We don't always have to be right. Although, you know, track record is pretty good. On the monthly chart, again, exact same thing we talked about. Disgusting bearish candle. Everybody gets bearish, rebalancing for the half, for the quarter, for all that good juicy stuff. And then what do we expect? Well, our back test of the 821 before the monthly cross to the downside. Can we, you know, avert the cross? For sure, it's a possibility. You know, in order for that to happen, we need to start closing above 414. If we push all the way back up to 414, everybody's going to be bullish. And we're talking about that was the buying opportunity. The bottom is in. It's free sailing from here. The market's like got everything priced in. It's bullish, blah, blah, blah. And then, of course, you know, potential rejection, and then we go much lower. But, you know, that's the difference between what we do and what everybody else does. We're already waiting for these moves to happen in advance. So when the move happens, we're like, yep, exactly as expected. We're not like, oh, my God, we're going to miss it, FOMOing in, because it's literally doing what we already expected. Literally doing what we expected. So, you know, everything playing out very, very technically, absolutely beautifully. At this point in time, though, we have to be very, very careful that we don't continue to just kind of shop around here, put in another lower high, and then see that meltdown, as that's essentially just our back test. That's all it is. The back test before we go lower, in my opinion. Now, it doesn't need to be the case. Does not need to be the case. So obviously, NASDAQ, IXIC, already got the move back down to the 200 simple. This is exactly what we've been talking about on the Dow and the S&P. We bounce to 200 exponential and simple. We get retest the 8 get rejected back down, go lower to the 200 simple, and then we can start trying to carve out a bottom. Obviously, since then, NASDAQ is trying to put in a bullish weekly candle. We are getting ready to leave the bearish control zone and get a hard buy signal. This is what a potential bottom would look like if we're going to find support on the weekly 200 and go higher. This is it. This is what it looks like. Now, the real question is the NASDAQ telling us the truth and it's going to go higher? And then the S&P and the Dow Jones are lying to us. NASDAQ's going to lead the market higher. They're going to, S&P and Dow Jones are going to front run the 200 simple. We're never going to get that opportunity. And then we go up. Well, I would say no, the NASDAQ is not what leads the market. I mean, it leads the market to the downside, but I don't think that the NASDAQ, people are like, oh, well, tech is doing this. So obviously, the broader market is going to be healthy because tech is having a dead cat bounce off the 200 simple. Seems more likely to me that this is trash and it melted down a lot quicker. And then in all actuality, it's just trying to front run that next move, but it's not going to be able to do shit until the S&P and the Dow Jones, basically they're like the market makers. And then these are like the ARK investors. So the ARK investors are calling the bottom, but the market makers are like, no, you don't know what the hell you're talking about. That's how I look at it. Again, we could be wrong though. Maybe the NASDAQ has a perfect technical bounce. We know obviously the 821 has already crossed on the monthly and all the momentum is to the downside. Doesn't mean we can't get that back test, but we kind of already did. So, this is sort of like a month and a half, 2 months ahead of our real indexes. So next, looking at the Russell. So if we go to the Russell, obviously doing the same thing, trying to put in some bullish divergence, trying to get a move back up to the upside. Still very much in a bear market. We broke down already on the Russell. Same thing. Come down to 200, meet the 200 simple, back test, and then go lower. Now it's acting as resistance. We're very close to confirming into a weekly bear market on the Russell, by far the worst performing index. But we are at the 200 exponential and simple. So regardless of our bias, if we think that this is trash and a bunch of zombie companies and it's definitely going lower, regardless of that, we need to respect the fact that we're at an inflection point on the weekly. We're at the 200 exponential and simple. So if we're going to find support, likelihood on the weekly chart is that we find it from this level. Now on the monthly, obviously melting down looks terrible. What are we really doing? We're bouncing 2018. We're bouncing 2020. We're just moving with the rest of the market. But we know that the Russell is trash. It underperforms to the upside and overperforms to the downside. So that being said, we're seeing the opposite of what we like to see in these markets. What we like to see is confluence. I want to see the Dow Jones. I want to see the S&P. I want to see the Russell. I want to see the NASDAQ. I want to see them all doing the same thing. But they're not right now. What they're doing right now is the two major indexes, the Dow and the S&P, are showing this as a back test before we go lower. The Russell and the NASDAQ are saying, hey, we already melted down and now we're ready to go back up. Not so much the Russell. Russell actually still looks like trash. But so that being said, we're not getting the confluence we like to see, but we are getting the move that we were expecting, because what we expect is this bounce off of key support levels. Everything, all these markets, all these indices are basically back testing their 2018 or 2020 high, the pre-Rona dump. They basically have just done, a full just retrace of the entire move up of the $10 trillion stimulus, the heroin shot that the economy got over the last couple of years. So, it makes sense that we would back test those areas, that we would see a temporary bounce. We would back test the 821 potential cross down, and then we can decide from there where we're going. So that being said, XLI, very, very bearish, but again, back testing key levels right now in between the 2020 highs, really in this case, 2020 highs, and then our fib. So as long as we're between this, I'm treating this like a little channel. Now we have a little W for a potential double bottom. If we break through this, we likely come back up and again threaten that previous high. So there's a lot of potential for a counter trend move continuation right now, especially just like we said, the monthly and the 6 month and the quarter and all this just ended. So the likelihood is that until the end of the month, we have some data points coming out and everything, but until that Fed funds, rate next hike, which we expect to be 75 basis points, until that happens, we fully expect the markets to try to just gain some steam and just run back to the upside leading up to that. And then after that, leading up to that potential bullish move, after that, we expect continuation to the downside. Now, it doesn't have to happen exactly like that, but that's how everything's playing out so far. So XLP next, obviously, you know, trying to come back up here. One of the most bullish sectors, one of the safety sectors, as we would expect, you know, no matter how poor people get, no matter how much their necessities cost, you know, as far as housing and, you know, insurance, all the stuff you have to pay regardless. Let's be real. We know Americans are not going to stop buying, you know, their basic necessities. You know, and call it what you want to call it. It's like, well, I mean, water is a basic necessity. Coca-Cola is not. And yet, for some reason, no matter how poor people are, they always have money for Coca-Cola. I mean, it makes perfect sense. You know, there's a difference between when people are like, oh, they put out the stats and they're like, you know, 20% of American families are food insecure. Well, it's like, you're like food insecure? You can't afford to buy rice and beans and water? Or you mean like you can't buy the same fruit roll-ups and, you know, steak and shrimp and all this stuff that you're used to buying? Because that's two completely different things, okay? If you're too poor to buy steak and fruit roll-ups, well, that just means you make poor decisions. If you are too poor to buy beans and rice and water, now, you know, we have a serious problem. So that's the differences. You know, that's why consumer staples are so important. People are always going to be able to buy those big brand, quote unquote, necessities. They cut out the more expensive stuff that they don't need. We start seeing them buy, you know, grocery store brands instead of name brands, etc. So that being said, this looks like to me the back test, the same back test we saw as every other sector went from a bull market below, back test below, confirm into a bear market, and then went lower. So maybe the consumer is actually strong and all the data points that we have are wrong. Maybe, you know, the record credit card debt, you know, the lack of savings, and people are, wait a minute, I keep hearing that the consumer's in a great place and they have record savings. Well, sure, if we take Jeff Bezos and 99 just regular people and we put them all in a room and then we say, okay, we're going to calculate the average. And you're like, whoa, 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 okay, are we going to use the mean? Are we going to use the median? Or are we going to use the mode? And you're like, well, I don't even know what the fuck those are because I went to school in the United States and they don't teach you anything. And I can't speak for other countries because I didn't go to school in those countries. I mean, I studied abroad, so I know the difference in some aspects. But if they don't actually teach you the difference, you might get tricked because you might look at, you know, those are 3 different ways to calculate an average, obviously. And the main way you calculate an average is you take those 100 people, you take their total amount of savings, and then you divide it by the 100 people, and then you say, okay, on average, everybody has $20,000 in the bank. Well, if you take that outlier out of that room, you take that Bill Gates out, you take that Elon Musk out, you take, you know, those people out, the 1% or 0.1%, and then you recalculate that, and then all of a sudden it's like, oh, I'm sorry, the average of those 100 people actually that they have in savings is, you know, $82. And you're like, well, what the hell? That's crazy. How did the statistics change so much? Well, we took the dude out that has $1 billion in saving, and he was throwing off all the numbers. That's exactly what is taking place right now when you hear these statistics about the consumer is strong, companies' balance sheets are in a great position. They're taking all the companies or all the consumers, and then they're using this data to give you bullshit lies. They're using statistics to manipulate the data. If you actually dig deep and start looking at these numbers, you will quickly see that the case is completely different. They say, oh, companies' balance sheets are in phenomenal condition. Okay, what companies? Well, we just average out the top 100. Oh, okay. So you took the 100 best companies in the United States economy, the ones that got the most money, and many of them, you know, the tech companies, etc., performed the best. During the pandemic, you took all those companies and then you looked at their balance sheets and averaged it out. Well, let's look at you know, minus the top 10 outliers and minus the bottom 10 outliers, and then let's calculate up that average and see. And you will get a drastically different picture. Take the top 100, remove out the top 10 of that 100, remove out the bottom 10 of that 100, and then look at those numbers again and tell me if you see the same thing. Because I guarantee you calculate it that way. You take out those outliers to the upside and to the downside, and all of a sudden, consumer balance sheets look like shit. Okay? Business balance sheets look like shit. Okay? That's a fact. I mean, you can take a look yourself, dig deep, spend a little time, and look at those fundamentals before you buy into all the BS. Because I'm going to tell you right now, when you look at just basic data, like how much is the consumer buying? And they're like, oh, it's up 5%. And you're like, oh, great. The consumer's strong because they're buying 5% more stuff than they did last year. So they're strong because they're buying more. And then you say, okay, well, what's the inflation rate? 8%. Oh, wait, hang on. So actually, if we do the math and we look at the real consumer spending, if the actual inflation rate is 5%, or I'm sorry, the increase is 5%, inflation rate is 8%, we're actually net negative 3%. Shit just costs more. So the consumer is buying less stuff, but it's costing more money because of inflation. So in all reality, the consumer is weaker by 3%. But when you look at the data, you're like, no, the consumer is 5% more spending. Congratulations. Everything's great. So we got to really dig deep sometimes on this data and not believe the bullshit. Now, obviously, if you have half a brain or live on planet Earth, you can, go around to your local, whatever, town, city, and look around and say, is there more businesses here or less businesses here than there were 3 years or 5 years ago? Are there more people walking around spending money? If I go to the mall, is there more people with shopping bags buying things or less people buying things? If I go to a restaurant, is there more people at this restaurant or is there less people at this restaurant? And then also, is there just more restaurants in general or less restaurants in general? Because if there's less restaurants in general, we have 100 restaurants, 90 of them go out of business, and then we go to like the 10 that still exist, and we're like, these restaurants are booming. The economy's booming. And you're like, oh, yeah, it is. Because the same 100 people or 100 restaurants business is now all being pushed into 10 because the other 90 went out of business. So it's all subjective. We have to really look at some of this stuff and not just believe the BS data that we hear. So that being said, is the consumer really strong? Are balance sheets of businesses really strong? Are valuations really legitimate? Or are we just waiting for the next shoe to drop? And what is the next shoe to drop? Well, we know what that is. We know what that is. It's earnings. We're waiting. We still haven't readjusted earnings. So, if we still assume earnings growth is going to be great and earnings are going to be great going into the future, and we've already adjusted price, so now the PE ratio doesn't look bad, and then all of a sudden the earnings drops, 10%, 5%, 20%, whatever, all of a sudden the PE ratio is all skewed again. So we got to pay attention to the numerator denominator. We got to pay attention to multiple compression. At the beginning of this year, I must have said it 4,000 times. If you were, obviously I do not condone drinking, and none of this is financial advice, obviously. But at the beginning of the year, if you played the drinking game where every time I said multiple compression, you had to take a shot, you're dead now. You OD'd on alcohol. You're dead. You're a dead human being. Okay? Because all we talked about was multiple compression, multiple compression, multiple compression. And now here we are seeing multiple compression happening, and people are like, multiple compression, check, it's done. No, half of the multiple compression is done. The price has readjusted. But the other half of the compression is the earnings. So until the earnings readjust, we can't get an accurate number. We really can't. So that being said, multiple compression. So financial sector melting down at support. Obviously our 2020 highs still very bearish inside of our descending wedge, tightening up here. Typically what happens with these descending wedges is we typically will see a breakout back to the upside. So we're melting down. Eventually we melt down too much. We start putting in some bullish divergence. Then we get a bounce back to the upside, put in another lower high, retest key levels, whether it's moving averages, Fibonacci's, we don't know. Tops back out, rolls back over, continuation to the downside. And then we have a high, we have a low, we have a lower high, then a lower low. Continuation to the downside, what it looks like. But before that takes place, typically, let's just say this was going to be the breakout, maybe a 9%, 10%, 12%, 16% move to the upside, something like that. Not unrealistic. And again, people will be like, oh, that's it. The bottom was in. Told you, idiots. Haha, should have bought the dip. And then it just happens over and over again for years, and that's called the bear market. XLRE, so real estate, obviously, hit our target, closed the position, got the retest, at resistance again, off of bullish divergence, off of the 382 macro fib, off of our head and shoulders. So at this point in time, we, after a trade setup plays out, we just let the market reset, and then we wait for that next opportunity to present itself. Obviously, real estate not looking too hot here. Next, we have XLV. So healthcare had a very aggressive bounce off the lows after the breakdown, coming all the way back up, retesting the 200 exponential and simple. Essentially, what's going to happen here? Well, it either gets rejected and goes down and we confirm it to the bear market, or it reclaims its levels and we go back up and there it is. Safety play worked out. Obviously, this is one of the safety sectors. This could very easily be a spring, a fake breakdown or a breakdown, and then, a massive rally. It could definitely be a spring. We'll have to see. This is not a very pretty chart now, so it's not really telling me much of anything, honestly. XLB, so materials. Obviously, we don't want to see materials slowing down, as that is essentially like a leading indicator for like the actual health of the economy, the same way like manufacturing or like industrial is. So that being said, broke down below the 236, back testing it for now. Looks like it wants to go lower. It's trying to build some kind of momentum right here, but look, it's building momentum to the upside. A bunch of green histograms left the bullish control zone, hard buy signal, and it's not going anywhere. Why not? It's stalling out because there's no actual buying. All that's happening right now is we're basically just holding the price up. And again, that's what that bearish reset looks like. Basically, the indicator oscillators trend to the upside, and then eventually price action kind of moves, runs out of energy, and then rolls over and goes lower. Hanging out at the lows, not good right now. So XLY, consumer discretionary. And it's important too, also, when we have a market like this with a very shallow breadth, as in, only a few things are going up. Like, we might see days where everything rallies a couple percent, but we can clearly look at a couple sectors or a couple charts and say, wow, that's a much better chart. Everything looks pretty shitty, but that chart's actually not bad. Matter of fact, you could argue it looks good. People are going to go after that sector or that asset or that whatever we're looking at because they're looking for, the best looking setup or the best looking chart or the most bullish area to deploy capital. So the difference is when we're in a bull market, the breadth is broad. Everything's going up and it's beautiful. When we're in a bear market, everything is going down. There's always going to be something in a bull market that's doing shitty, like pot stocks for the last couple of years. There's always going to be something in a bear market that's doing good, like, healthcare, for instance. So people will tend to flock to those things that are overperforming or at least performing some. And that's why the breadth looks terrible, but some charts can still look good. So most everything looks crappy and is going down, but there's a couple things that are doing well. And that's why it's important to focus on those couple things because everybody's going to go after those same things. That's what the energy trade was all about. Did energy do really good for the last 8 years? No, it was terrible. And everybody hated energy. And then all of a sudden what happens? Everything else starts doing bad and energy starts doing good. And now everybody's all about energy because there's nowhere to put their money. So if there is something that looks good, like the energy trade, everybody piles into that same trade. And that creates massive amount of volatility in that. That's why we see the massive like 25+% drops in a couple days in stuff like natural gas or oil because everybody's positioned to the upside on that. And then all of a sudden there's a little swing, a little sell-off, and we start seeing, that volatility pick up. So that being said, we can look at most of these sectors and say, okay, nobody gives a shit about this sector because it looks like trash. So there's something better to play with. And that's what we see. If you're going to go consumer discretionary or consumer staples, obviously you're going with consumer staples. The discretionary stuff's the first to go. Now we're starting to build some momentum on some of these other ones. We're hitting key levels. We're seeing the pivots. We're getting those back tests. But that being said, we still want to focus on what looks best, what good setups we have. So XLU, one of the better setups, one of the safety setups, back on top of the 200 exponential and simple, one of the best sectors. The only problem is, once again, we sold off from this level and had a massive sell-off all the way back down. We saw the indicator oscillators go from the bullish control zone all the way to the bearish control zone. And now here we are. We're very close to re-entering the bullish control zone. Now there's still a ways to run back up to 90. We're only at about 75 right now. But look where we're at price action-wise. If this keeps running up here, the indicator oscillator gets up back to that same 90 level again, we're probably not going to be putting in a new high on price action. So what is that? It's a bearish reset. And then we likely go lower after that because we used up all our energy just to get back to a lower high. And then once that energy's out, now we have plenty of energy to use to the downside that probably takes us to a lower low. And we have a high, a low, a lower high, a lower low, probably a lower high, and then probably a lower low. And this is one of the better looking charts, so we have to be careful. XLC, communication, probably the worst sector. Again, backtesting those key levels, just getting absolutely destroyed. But again, trading very, very technically. From our fib low to our fib high, bouncing the 618 perfectly. Backtesting the 2020 high, backtesting the 0.5. We would expect this to act as very strong resistance and then likely go lower, down to something like 46. We do see some bullish divergence Now we're seeing the bullish divergence play out, and it's playing out pathetically. Why is that? Well, because this is an underperformer, so nobody gives a shit. You're like, oh, this is a nice trade setup, counter trend in the worst sector. So you're like, do I want to take that? Or do I take the one that's like, bullish divergence in a bull market in the best performing sector? I mean, obviously, you would expect that one to perform better. So that being said, XLK Tech bouncing that 382 perfectly. We have this descending wedge right here. It's tightening up. We see obviously our parabolic trend lines. The yellow is like, just sort of a downtrend. And then the orange, a little more intense of a downtrend. And then the red is a really intense downtrend. Well, we broke through the red. Now we backtest the orange. We consolidate here long enough. If we break through the orange, we likely backtest the yellow, which will line up with like the 200 exponential and simple. And then obviously we have our 236 up here, somewhere around like 141. Again, bearish move to the downside, bullish breakout, and then bearish continuation is what we would expect based on, statistics, likelihood of our next move. So XLE energy. So we got the back test of the 200 exponential and simple, the reversion to the mean, still technically in a bull market, down at the bottom levels, bearish control zone, hard buy signal, potentially exiting the bearish control zone, multiple green histograms on the daily. Obviously, we hit our target almost to the T. We were expecting somewhere between the 382 and the 0.5. And then again, we would expect to come back up here, potentially put in a lower high. Where's it going to go? We don't know. Maybe even a double top. We don't know exactly what's going to happen, but what we would assume is some sort of form of double top or lower high, and then continuation to the downside. Long term, again, still very, very bullish on energy, but in my opinion, we have just played out a 5-wave structure, and now it's time to correct that 5-wave structure before we see continuation over time. And, what fundamental events is that going to line up with? We don't know. Too early to tell. XTN transportation, trying to carve out a bottom here. We basically have a double bottom. We have some bullish, no, we don't have bullish divergence. I'm sorry. Just consolidating at the lows. Not good. I mean, this is just our back test of the 2018 highs. And we're just hanging out down here. I mean, this is pathetic. Arguably, January 2018. So, this is basically just barely hanging on to support for now. And what is energy? I mean, what is transportation? We got to move stuff around. When the economy is doing good, we got to move more stuff because everybody's making stuff and selling stuff and buying stuff and going on vacations, and everything's got to move around for the economies to function. So if we see transportation slowing, we know probably the economy's slowing. So are we going to go into a recession? Are we going to go into, negative growth or stagnant growth? Or, I mean, we don't know for sure, but we know, transportation, obviously, energy, obviously, two of our horsemen. So XSD, semiconductor ETF, there's a couple of them too. The only reason I've been looking at this one lately is just to get a different perspective on it, but there's plenty of other semiconductor ETFs. It doesn't really matter. We're just looking for like the broad range of things. Like, because if we look at an Intel chart, it's going to look like shit. If we look at an Nvidia chart, it's going to look better, but still shitty, shorter term. When we look at this, we kind of get like the kind of broader scope of the market. So semiconductors in general, we got to be careful because we lost that support. Now we're reclaiming it for now. So again, could this just be a spring, a breakdown before we go much higher, the same way that a throw over is essentially a break up that fails and then we go much lower? Well, we talk about this scenario playing out for the head and shoulders. And it's like, sure, maybe we broke down from support. Maybe we reclaim support, push all the way back up, and we get a little bit more pretty of a head and shoulders. But realistically, we're confirming into the bear market. And this is just our first back test, potentially. This is just our first back test before we go lower. Before we confirm, yep, it's a bear market and we can't get out of the bear market. So now we're just going to put in another lower low. And obviously we have lower highs, and lower lows trending to the downside. We would expect that to continue. And then the 210, again, everybody talking about the inversion of the yield curve and blah, blah, blah. Right now, that doesn't matter. The yield curve already inverted once, so that's it. It's a non-event from here on out. Because it's like, oh, no, the yield curve, it inverted again, it uninverted, it inverted again. So every time people are going to say, oh, recession, no recession. It's inverted, it's not inverted. I mean, who gives a shit? The only thing that matters right now on the yield curve inversion or the 210 spread or the 1030 or the, whatever, 3-month, 5-year, the only thing that matters right now is, do we roll over and go back to the downside, or do we continue to the upside? Because if we continue to the upside, we already have violated the 2018 highs. If we continue to the upside, we're going to retest, the 2007 highs and 5%. If we don't, we roll over, we go into recession. So either way, I mean, who cares? Rates continue through the roof. We keep fighting inflation. We probably go into, the equivalents of, stagflation. We have inflation, we have high rates, and we have stagnating economy. So that's worst case scenario. What's best case scenario? Soft landing and somehow we avoid a recession. What's likely scenario? Go into a recession, rates roll back over, this acts as resistance, and we go down. So in my opinion, most likely situation is we break out and see stagflation, which we've been talking about for some time now. It is definitely possible this rolls over here, acts as resistance, and goes lower. There's not really a good situation for stocks or bonds unless this rolls over, and the good situation is we go into a recession. So if our best case is a recession and our, real case is, stagflation, I'm not too bullish on risk on assets for now. So that being said, let's take a look at the DXY. So DXY, so we just hit our, again, I promise you, I absolutely promise you, people are going to say, that's it, it's topping, shooting star, DXY is topping out, time for the relief rally, it's over, it's the top, it's done. Well, what just happened? Oh, look, what are these lines? What are all these lines for? And why did we just touch them perfectly? Exactly. Does that count? Does that mean something? Why doesn't anybody else have these lines? That's weird. I mean, all we did, backtested our macro 786 and our 0.5. Okay, so again, I know this chart is like insanely busy. I'll have a video soon on how to draw this chart. Now that people care about the DXY and it's so important, I will show exactly how I drew this chart. But essentially, we have a peak from 1985, and we have fibbed all the way from 1985 to the low in the DXY in 2008, and that one is in red. And then we have an orange, a fib from our 2001 high down to that same low right here. So that one's in orange. So we have a red and an orange fib. And then when we zoom out right here and we say, okay, so we have a high, we have a low, so we're in the middle of an internal retracement because we're not going lower, so we don't have a new low, so it's an internal move. So now the next thing to pay attention to is the internal peak, which is the fib from 2001, and the internal peak, which is the fib from 1985. And when we zoom out here and take a look, that was our target was what? The 786 internal retracement in orange and the 0.5 internal retracement in red. So we came all the way down to the low, and then we moved back up 50% of the way from the high to the low. 50% retrace, which is Charles Dow theory. We get a move, we give back half of that move, and then we continue in the direction of that move. So that would be topping out and going down. So is it possible that happens right here and this is it? Definitely a possibility. 100% possibility the DXY has topped out. Same thing from here. We have from the peak right here to the low right there, and then we retrace 786. What does that mean? Well, the 786 is the deepest retrace we should ever have before we threaten that previous high. The 886 sometimes will act as resistance, and it's useful at times for like a stall, but it very, 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 very rarely acts as a reversal point. So the 786 is the last chance for the DXY to reverse to the downside before we likely go higher. The 0.5 is obviously just your average Charles Dow theory retrace. So let's look for confluence. What if this is it and it tops out and it just starts going down? That's not a bad scenario for the world. The dollar goes back to being weak, takes a little pressure off of the world economy, and then things can go back to normal. That's actually a good scenario. And this seems like a likely place it could reverse from. Now, what's the other scenario? The bullish dollar scenario. Well, the bullish dollar scenario is that we just continue to the upside. So where do we likely continue to? Well, the 886 in orange, but we know we're not going to top out there because statistical probability of that topping out is like less than 5%. So at this point in time, there's a 95% chance we rip through the 886 if we go higher than the 786, and a 5% chance we reverse here. So realistically, what does that tell us? Well, the next macro red fib target after the 0.5 is the 618, and then the next likely target, if we take out that 786, is the previous swing high because the 886 is not going to reverse us. So again, what do we see? Confluence at the 618 in red and the 1 in orange, which is the 100% move back up. That's our next target. So does it seem likely that we hit that target? Well, I mean, we don't know. Honestly, we don't know. That's why we just put one target, and then we have a next target after that. And then when we hit the one target, we put a next target after that. And then we keep having targets to the upside. So that way we have a bull case scenario if we keep going. We have a bear case scenario if we keep going, if we reverse from here. Now, is it a good idea to pick tops on any asset ever? No, of course not. Is it likely that we do top out from this area? Well, we're in the bullish control zone around areas where we have previously topped out. So it doesn't seem crazy to think the dollar could top out around this area. Now, what about momentum? Do we have momentum in our favor? Well, we're confirming into a bull market, 200 exponential and simple on the monthly, bullish. Obviously momentum in our favor, all green histograms, blue slope line. Seems likely we actually probably continue from here, especially after taking out these two highs. So we have a bull case, we have a bear case, where we just hit another macro target to the upside, the next macro target to the upside, obviously around that 120 level. Why are we reversing right here? Why are we showing some toppiness on the daily? Because we hit a target. And what happens when you hit targets? People like me take profits. So when you lock in those profits, what happens? Well, if you were a buyer and then it went much higher, you start to sell. And when you sell, you start to see, what looks like a short-term reversal or top, etc. So that being said, we'll see what happens from here. We don't know for sure what's going to happen one way or the other. But when we look at the monthly, it still looks very, very bullish. When we look at the weekly, it still looks very, very bullish. But when we look at the daily, it's like, oh, look, a reversal candle, a shooting star. Oh my God, that's it. Look at this just gigantic reversal candle. There's a big wick and it's red, and that's it. That's the top. Sure, maybe it is. Maybe it's the top for a couple days, a couple weeks. Maybe we see continuation here. Maybe we print another drive of bearish divergence. Maybe we just keep ripping to the upside. We don't know what's going to happen. But I would say right now, the amount of credence that I give this candle compared to the amount of people saying the DXY is topping, look, I'd probably be a little careful on that after zooming out a little bit. But I mean, most people are probably looking at like a 9-minute candle or 1-minute candle or 15-second candle or something. So they're like, oh my God, look, it's melting down. They're not looking at, monthly or yearly charts. So Tesla resumed the trend back to the upside. Looks like a break out of our little triangle right here. Obviously, it happens. Come back down, stop us out at a, basically like break even essentially, and then continue ripping to the upside. It happens. It could have easily not moved our stop and still been in this trade. But the truth is, I just stick to the guns. Do what the charts are telling me. Sometimes you're like, I could have probably stayed in that one a little longer. But Tesla had plenty of chance to move up already and has been performing pretty pathetically. So I'm not mad about getting out of that one. So that being said, looks like it does probably play out, that trade setup. Tesla does look okay on the daily. If we zoom out and look at the weekly, it just looks like a back test. As long as we're above the 572 level, it looks okay. Seems very likely we do retest that level sometime in the near future. And then after that, probably 440. It's just a matter of when. We're in the bearish control zone after a pretty massive move to the upside. Still obviously bullish on the weekly. So that being said, seems like we probably do see a little more continuation to the upside. Try to avert the bear trend, but likely doesn't happen. So now let's talk about China. So obviously NIO, big electric vehicle producer in China. So let's look at this chart. What's happening right now? Well, the reversion of the mean is currently playing out. The back test of a 200 exponential is simple. Obviously we back tested here and then we melted down. It's another back test, another reversion to the mean. So what do we see typically happen? Well, you're in a bull market. Obviously, we get the reversion of the mean, go into the bull market. Here, we don't ever backtest the 200 exponential and simple. Here, we start to look toppy, putting in lower highs and lower lows. Then we break down bear market. Then we backtest eventually. So one of two things is going to happen. We know what those two things are. We either get rejected here and go lower, or we reclaim the 200 exponential and simple, and then potentially start resuming the bull trend. So while I'm still not bullish on China, this chart is telling us, hey, there's a possibility that we reach this inflection point at like 25 very soon, and then maybe even go higher. At which case, we should be bullishly positioned in this. Now, obviously, we don't know that's going to happen, and when we zoom out to longer time frames, we see what's going on here. Well, complete meltdown on the weekly, and now we're trying to reclaim the weekly. Well, what happens a lot of the time when we try to reclaim the weekly? Here we successfully do it, then we melt back down. Here we almost do it, then we melt back down. So maybe we almost do it and we melt back down. Maybe we successfully do it, and then we go into another bull trend. Very, very close to telling us one way or the other what to expect. So let's look at our indicator oscillators and what are they telling us? Well, we already put in a decent move to the upside. We came all the way from the bearish control zone all the way almost to the bullish control zone. And where are we at? Nowhere. We just went sideways, up a couple percent. So it doesn't look particularly great to me on the weekly. It looks more like it's going to fail and get rejected and go lower. What do we see on the monthly? Well, the monthly cross happened. We completely melted down, and now we're back testing the 8. So if we can get back above the 8, we retest the 21. If we get back above the 21, maybe we can flip the 821 back to the upside and start the bull trend on the monthly. We're in the bearish control zone, all red histograms. Could we be bottoming? Definitely a possibility. But when the monthly chart looks this nasty, we can't really trust the daily and the weekly chart nearly as much as we would if the monthly chart still looked great. So that being said, now let's look at Baidu. So what is happening on Baidu? This actually starting to look pretty damn good. Inflection point, right? We lost the 200 exponential and simple, back tested it, melted down. Pretty deep correction, 786 macro from the bottom in 2020 to the top of that parabolic move. Now we're back on top of the 200 exponential and simple. We're back on top of the heart line for this giant sideways, consolidation that's been going on basically since this is 2010. This is our most recent high. But we could see we basically just spent 12 years inside this range. Now there's a couple days in here we were outside the range. There's a couple days here we were outside the range. But we spent 12 years consolidating in this range. So what do we expect to happen for the next 12 years? We probably consolidate inside this range because we're only going to break out one time, with the exception of like a throw over like this, which is a failed breakout or intentional market maker manipulation, whale move, whatever you want to call it. So realistically, what are we looking at now? Well, we're back to neutral inside the channel. So we're basically like, if we go up, it's an even amount as if we go down roughly. And then now we have reclaimed the 200 exponential and simple. So there's a possibility now, we already flipped the 200 exponential up. There's a possibility now we flip the 200 simple bullish and then technically we resume a daily bull trend. And where does that likely take us? Well, if we're right and we go bullish from here, probably takes us back to the top of the range. So maybe something like 245. So what is our, potential upside target? Like 61% on Baidu. How do we know if we're wrong? Well, if we lose this support, it's not going to look good. But realistically, if we put in a new low, it's really not going to look good. So at this point in time, the beauty of the 200 exponential and simple moving average, the beauty of the reversion to the mean play is we can risk the least amount possible and find out if we're right or wrong right away. Because if we're way down here, move back up here, and then we just get rejected and go lower. If we're right here, we know right away if we break down back below the 200 exponential and simple again, that the trend has failed, the breakout has failed, and we're probably going to go lower from there. So let's just say we wanted to enter into a tight stop loss trade right now with a potential move back up to the top of the channel. What would we look at? Well, we would just look at, okay, if we break below that neutral heart line, if we break below the 200 exponential and simple, start consolidating and spend too much time below there, we want to be out of this trade. If we consolidate here long enough, this flips blue, bullish, and then likely we get an internal retracement. So how do we figure out those targets? Obviously, we have the top of the channel. We can put a broad trade setup in play like this, where we have a 6.8% stop loss below like 143. We have a 58.9% target to the upside, retest of 244, which is the top of the channel. What does that give us? 8.6 to 1 risk reward ratio. The monthly chart is obviously still very bullish on China, but the daily chart is getting ready to, potentially show us some, beginning of a daily bull trend. So again, regardless of our bias, what we think is going to happen, we now have a potential setup here that's actually pretty good risk reward wise. And if we go from the top of the peak right here, the all-time high, down to our recent low, which was May, we now have our internal retracement. I'm going to switch that to yellow. So we know without taking out a new high or taking out a new low, where are some likely targets within this area. So from our low right here, that's our 236. We're already above that. The next upside would be the 382. We see quite a bit of resistance and support around that level. So realistically, the 0.5, Charles Dow theory, 50% retracement, takes us to 190. The 618 is 219. And then obviously we have that heart line support the top of the channel support as well. So realistically, is the minimum trade setup that we're still interested in 23% upside to the 0.5 with a 6.8% stop loss? That's 3.4 to 1. That's not a bad trade setup. It's not amazing, but it's not bad. But this is really just to wet our mouth, just to get us in that position while we wait for the real trade setup to play out. And the real trade setup, I mean, being the 618 retrace. And then again, that's going to give us 43%, 6.3 to 1, same stop loss. And then finally, if we look at the, most bullish bearish scenario. Why is it most bullish bearish scenario? Well, it's the highest push up without breaking through the range, without, potentially threatening the new all-time high, assuming that we just move up and then eventually roll over and go lower. Now, of course, that doesn't have to happen, but there'll be a million signs before it does. And, that's that 59% upside with the 6.8 downside, 8.6, roughly to 1. So what are we looking at right now? Well, we're looking at technically a bear trend, potentially reversing back into a bull trend with a 3 to 1 risk reward ratio, a 6 to 1 risk reward ratio, or a 8 to 1 risk reward ratio. All of those are acceptable trade setups. Now, of course, we want to take some profits along the way. Of course, the trade setup could fail, but I actually like the way this looks. And no one's talking about China, which is always good. Whenever no one's talking about China, whenever no one's talking about something, I get excited about it because it means no one else is looking. So what does that mean? I get to enter my position myself accordingly, and then all of a sudden when everybody else goes, hey, look what's going on over there in China. Wow, that looks pretty good. I'm going to buy in. What are they doing? They're pumping my bags. They're pumping up my position. And then what happens after that? Finally, everybody's excited. China's getting ready to go to new all-time highs. Baidu's up here at $247. We've already hit our first 2 trade setups, took profit on them, and now we're taking profit on the third one. And what is happening? Everybody else is FOMOing into China now. And then what are we doing? We're like, here, hold these bags, and I'll be right back. Okay? I'll be right back. Just hold this. I'll be right back. And then we sell them our Baidu at $247, and then it melts back down to a new low. Or maybe it goes higher after that, and then we can rebuy. But we already locked in our gains. And that's the most important thing. And how many people are talking about China right now in a good way? Haven't even heard anyone mention China. The only thing I see on China is lockdowns and, mandatory vaxes and blah, 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 blah. Now, we do have to be careful of, potential bearish divergence. We have to be careful of potential rejection. But, if we take 10% of our trade account and we take a 6% loss on the 10% of our trade account, what are we talking about here? We're talking about nothing. A 6% loss of 10% of our account is 0.6% of the account. So that's risk reward. That's probability of success. That's position sizing, all working together, telling us, okay, we have a potential reversion of the mean, so we can have the tightest stop loss possible. We have favorable setup, because we're potentially switching into a bull market here. So it goes from being a bullish setup is 66% probability we stay bullish. A bearish setup is 66% probability we stay bearish. And then a neutral setup, which is basically where we're at right now, 50-50, could go either way. Coin toss, it either goes bullish or bearish. We don't know. We don't have an advantage because we don't really have a trend. But with a high enough risk reward ratio, which is, in a bear market, a bear trend, we want at least 3 to 1 minimum. In a bull market, we want at least 2 to 1 minimum. So at a neutral setup with a 3.4 to 1 risk reward, pretty good actually. That's not bad. And then of course position sizing obviously, and then the potential for step 2 and step 3 playing out. All of a sudden, this looks pretty damn good to me. Now, of course, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. China probably melts down, and who knows? Maybe they attack Taiwan. I don't know what's going to happen next. This trade setup probably fails because, the economy sucks. But, based on technicals, looks pretty good. So maybe we'll take a bite on that one. And that's the rationale between what's going on right now. Now, that being said, let's look at BABA, obviously another big China stock. Not quite as bullish, but we see the reversion of the mean. We see the double bottom. Took us all the way back to the 200 exponential and simple. We can see essentially that was a 786 macro retrace after a breakdown of a long period. We don't have that same kind of like distribution channel, but what we do have is the same tools for a breakdown from the high to low, and then some targets basically back at the 382. So if we consolidate here long enough, we likely get the Dow theory retracement 0.5 or, possibly the 618. We see even on the way down, before we knew where the low was going to be, look at all that confluence. The 786 rather is that resistance here before we melt down. And then we see obviously a perfect touch of the 618, dead cat bounce, perfect touch of the 0.5, dead cat bounce, blew through it, back test the 618, melt down. Don't see much support at the 382, but then obviously resistance through here, breakdown straight through the 236. And then again, we eventually put in our low down here. And then from when we put in the low, we start seeing back test. So we obviously don't know where the low is going to be. We don't know where this fib goes. But in hindsight, when we look back at it, we say, oh, okay. So the algos obviously knew where the low was going to be. And that's what this gap down was to complete the algorithm, because it was starting to look exhausted here. So that being said, we get the bullish divergence. We come back up. We get the back test of the 236. Here's the 382. So again, potentially neutral. Now, we're still technically bearish, but we're in between the 200 exponential and simple. So if nothing changes and we just go sideways here, they both flatten out, and then the probability of going up goes to 50% instead of the probability going up being at 34% because we're still technically bearish. So that being said, we can look at those potential same type or similar type trade setups and say, okay, what's going to happen here? What is, what if we want to take basically that same trade, but on BABA instead of Baidu? Well, again, we want to keep a tight stop loss, which we can do because we're trading, off of the mean, off of the average fair value price of this over the last 200 days, exponential and simple calculations. Next target to upside, Charles Dow, 25%. Stop loss, 6% roughly for a 4.3 to 1. Oh, this is actually slightly lower probability of success because we haven't flipped the 200 exponential yet. About neutral. Slightly better risk-reward ratio for our initial trade setup. And then what happens if we, get into this trade setup, we hit the 0.5, we take some profits, and then this thing keeps deciding to rip to the upside? Well, next target we have is a 618. Again, giving us a nice little 50% upside, 8.6 to 1 risk reward. We don't have that same channel that we can look at like we did on Baidu. But when I'm looking at a trade, I'm not looking at, okay, I like this one asset in this one market, and I'm going to just put all my eggs in this one basket. No, I'm looking for like 2 or 3 similar stocks or similar areas of interest, because one's going to overperform, one's going to underperform, and one's going to do average. And if I bet all on the one that overperforms, I look like a fucking genius. If I bet all on the one that underperforms, I hate myself for picking the worst one. And then if I bet on the average one, I'm always going to say, well, it could be worse, but it could be better. Meh. So why not just bet on all 3? That's how I look at it. So I'll look for 3 potential positions. In this case, I'm looking at NEO, I'm looking at Baidu, and I'm looking at BABA. Obviously, we already have the EDU play trade in play. That one is very, very close to our take profit, which is the back test of the 200. So I'm very close to closing that one out with some very nice profits. Congratulations to anyone else who took that trade setup. And then, also at the same time, I'm saying, oh, I'm very close to taking profits on that one. How am I going to enter into another China trade at the same time? Well, maybe that one fails. Maybe I took profits too early on the EDU. We don't know which one's going to happen, but I'm always happy to lock in gains and then just enter into another trade and then either get taken out of that trade, re-enter into the first trade, whatever. It doesn't matter. We're not going to be right all the time. The best thing, in my opinion, to do is lock in gains, take profits early, and then re-enter at a higher price. Because let me tell you the truth about Alibaba, okay? Let me tell you the truth about China. I don't give a shit how many shares of BABA or NEO or Baidu or EDU or anything else. I don't give a shit how many I have. I don't care. I'm not a collector of Chinese stocks. You know what I like to collect? Money, dollars, wealth. So I don't give a shit. I'm never going to be mad saying, oh my God, I used to have 1,000 shares of Alibaba and I took profits too soon. And then when I rebought, I only have 900 shares. I don't care because I'm not collecting Alibaba. There might be a reason that you collect. Maybe you want to collect 1 whole Bitcoin or 21 whole Bitcoin or whatever, 100 Ethereum. You might want to collect something, but just remember, you're collecting Pokemon cards or whatever. I mean, who gives a shit? Because there's no time in my life when I'm going to say, most likely, oh man, if I just had one more BABA stock, I would be so much better off. No, we don't care about that. We care about the money. So that being said, that's one of the biggest bridges that people need to learn how to cross, is taking profits, the trade continuing in your direction, and then being able to rebuy higher and not be mad about it. Instead of being stubborn and saying, well, I'm not going to pay more than I sold it for. That's stupid. Well, no, it's insurance. It's the same as we talk about all the time with your car. You know, you got a $50,000 car, insurance is, you know, $1,000. You don't buy that insurance expecting to total out your car. You assume that that $1,000 is an option for if something goes wrong, you're covered. And that's what it is. That's what taking profits is. Just in case this is the top or the bottom, I'm going to lock in some games right now. And then if I'm wrong, I'll still happily continue paying my insurance and go about my life. I don't just say, oh, I drove to the supermarket today. I didn't total my car. This is bullshit. I'm getting ripped off. I'm no longer paying my insurance because I drove one time to the supermarket and wasted that insurance. I also don't cancel my insurance and say, oh, I don't need insurance because I haven't gotten a car accident in 10 years. No, you don't do that. It's the opposite. You look at the insurance as a good thing, not as wasted money. And that's the same as taking profits. It's just about readjusting the way you think about these same things. So that being said, that's my China montage right there. So again, China probably goes to zero. It probably crashes, probably goes to anarchy. They probably, you know, blow up Taiwan and that trade setup fails. But also it's worth paying attention to because there's some really nice stuff there and no one's talking about it. So as long as China's hated and unpopular and nobody's talking about it, nah, trade setup probably looks pretty good. So NVIDIA. Okay, so again, talking about semiconductors. Semiconductors have been getting wrecked. This was a big stab down right here. Came down to the 786. Didn't quite come down to our target, which was the entry off of the 382 macro from the macro bottom all the way to the high. Obviously the 236 in red, that was key support. We broke down from that. The next target was the 382. We slightly front ran it. So one of two things going to happen right here. Either we come back down and we hit the 382 and we get that perfect entry, or we just front ran the 382 and now we're going to push back up and miss the trade setup. So what I did was entered into a small position in AMD, Micron, and NVIDIA. Now we'll see what happens. We'll see if they play out. You know, potential nice move, bullish divergence off of some key fib retracements. Could fail, could play out. Nice risk reward ratio. So again, we'll see. Semiconductors are loved and then hated. I have a feeling, you know, we never push back up to 200 exponential and simple. I have a feeling based on the fact that, you know, every chart ever eventually touches this 200 exponential and simple, that eventually we do. Now, I don't know where that's going to be from. They could continue melting down and it could touch at $80. Or they could bounce right now and, you know, we could touch in a week at 210. I don't know which one's going to happen, but again, with nice risk reward ratio, position sizing, you know, we can enter into these trades confident that even if we're wrong, you know, we made the right decision. So that being said, NVIDIA, AMD, Micron, some setups are slightly better. Some setups are slightly worse. We see obviously that same bullish divergence on AMD, on the two indicator oscillators here. Very clearly we see the rejection off the 200 exponential here. We don't see that same, we didn't see that same move back up on NVIDIA. It was much less bullish on the most recent move back up. So again, we don't know which one's going to underperform. We don't know which one's going to overperform. But what we do know is, you know, we're basically at some key levels. Oh, where's the rest of my... Oh, all right. Hang on. Sorry. So depending where we're fibbing from, depending what we're looking at, you know, we can see some pretty good confluence on the way up from the 2018 lows. You know, obviously we see some resistance and support at the 786 and then again at the 618, exactly at the 0.5. Nothing really at the 382, and then again resistance and support at the 236. And that was all before we knew the high was in. So now when we look back at it and say, okay, that's what's up. We're seeing quite a bit of confluence there. This was clearly an overshoot of the 236, but took us to the moving average. This was clearly a front run of the 382, but we know the target would be like that back test. So that being said, we have some key areas in mind. We have a decent trade setup. We don't know how it's going to play out, but there's definitely some potential here for that push back up to somewhere around like 100, maybe slightly less, which is a decent setup. I mean, it's over like 25% from where we're at right now. So again, we'll see what happens with those. We're clearly at the bottom of the range. We're putting in bullish divergence. We're bouncing at or around key fib levels. And then again, when we zoom out and start looking at like our longer term time frame charts, a lot of times if it looks like we're bouncing off nothing, it's typically going to be a moving average on the next time frame up. In this case, typically going to be like 200 exponential or simple. I would have loved to see the 200 simple retest because it would have been so much cleaner off the 200 simple. Unfortunately, you know, we didn't get that 382 200 simple. So, you know, maybe it's a front run, maybe it's just a little bounce before the next move down. But we have trade setups accordingly. So, you know, even if we end up getting stopped out at break even, we just look to re-enter at that lower entry price. So that is our semiconductors. So Apple, again, looking like it wants to get that back test in. We've been talking about this for some time. Obviously, these ones have confirmed into the bear trend, but never got the back test. So it seems likely we would get that back test. Obviously, off of bullish divergence, off of key fib levels, it's playing out. So the Google play, we talked about this, about the split and the run up potentially in anticipation, bullish divergence off of the lows right here, and the likelihood of retesting like 2,500 prior to the split. And then obviously when we look at Amazon, this was on the, what is it, 18th? Yeah, 18th. When we look at Amazon, it did literally the exact same thing leading up to its split. So it moved back up here, and then on the day of the split, that was the absolute like blow off top before we just went right back down to the lows. So we don't know what's going to happen with Google, but it seems likely that we get that blow off top over the next, what is today, the 7th, 8th? So over the next 10 days, you know, maybe we get the rest of that move up. Maybe we get a little overshoot. It seems likely that we're basically going to move back up to 2,500. Unfortunately, on this one, we did get slightly front run, so we did not enter into this trade. But it is what it is. Again, I don't like to chase. Nothing wrong with it as long as you're intelligent about it. You can chase stuff, that's fine. I'm too stubborn. I just say, oh, I'll just wait till the market comes to my targets. Obviously, 99% of the time, maybe 95, that happens. So. Amazon, so yeah, I mean, I don't expect much out of Amazon right now. I do like that we have sort of took out that previous little lower high right there. That's okay, consolidating right here. Maybe we do get a pushback up to the 382 at about 136. Seems possible. I think there's a lot better trade setups right now than Amazon. And then Microsoft, we still have this active trade setup in play after the breakdown. Came down perfectly to our 382. See, that's the difference though. This one hit our 382 absolutely perfectly. We got the perfect entry, and we have a nice trade setup. Sometimes there's a slight front run like this. We miss it. It runs back up. You know, we don't get that trade, and then maybe we get the same trade right afterwards. You know, because here would have been a front run. Here was the perfect entry. So maybe that's what's going on in some of these stocks that front ran the 382 already. You know, maybe not. We don't know. But this looks like the back test playing out nicely, obviously. You know, and sometimes you're going to miss a trade. Sometimes you enter into the best trade. It happens. Okay, so it's been a while since we took a look at Twitter. Obviously, still a bunch going on with Elon Musk, the old musty boy. I mean, we don't know what's going to happen here, obviously. The market is pricing in that the deal doesn't go through, or it goes through at a much lower price. You know, this was the run up when the deal was announced. It was basically a gap up from like the existing price at like $40 up to the acquisition price. Consolidated around there for a little bit and then dumped. Market is saying we don't believe this deal is going to go through, and if it does go through, it does not go through for that price. Obviously, we don't know what's going to happen. I honestly don't think Elon knows what's going to happen. I think he just wakes up every day and just does whatever the fuck he wants, which he deserves to. I mean, he's the richest man on earth, so I mean, he deserves to troll the internet. He deserves to do whatever the hell he wants, and if you don't like it, he'll just pay you $1 billion and go about his business. You know, which is what happens if he decides, you know, the Twitter deal's no good. So, do I think Elon would piss away $1 billion if he feels like it? Yep, I definitely do. Do I think he wants to just waste $1 billion? No. Do I think he really gives a shit though? Nah, probably not. Probably not, honestly. So, but I mean, is a billionaire going to be the savior of mankind? I mean, I wouldn't bet on it. If there is going to be a decent billionaire, is it going to be Elon Musk, you know, or one of those guys? Yeah, probably. I mean, there's definitely like degrees of evil, and I think Elon Musk is like what? Like he's like chaotic neutral. He's not like good. He's not evil, but definitely like thrives on chaos. You know, somebody like Bezos, where's he stand? I would say he's like, you know, cold-blooded evil, like lizard evil. So that being said, Twitter, as long as it's holding this ascending support, it looks okay. It looks okay. Obviously, in a bear market, got the retest on the Elon news, losing the 0.5, and that ascending support looks bad. If it breaks down below 33 bucks, it's going to look really bad. And, next target to downside would be 27. If it holds support around this level and pushes up, it's got to get above the 200 exponential and simple on the daily to even look good, which means it has to get above like $44, and then the target is like 54. So that's your acquisition price. There's nothing really here, in my opinion. So we'll see what happens. This is it's terrible. It's absolutely horrible. If I had a guess, if you showed me this chart and go, hey, what do you think this chart looks like in the future? Like just a guess without knowing what it is or any idea, what this company does, anything like that. If you just showed me this chart and I say, okay, there was a high back here in 2013. There was a low right here in 2016. And then there was a slightly higher high here for a second in 2021. And we have an ascending support line. I would tell you, my opinion, honestly, probably what happens is we probably, if I had a guess, and now this could be completely wrong. I could literally be completely wrong. But my guess on what happens with this chart going into the future is that eventually we break down from support and we go to new lows. That's my guess. Now, it doesn't have to happen like that. When we look at the monthly, does it tell us a different story? Not really. Higher monthly close right here. So, why am I bearish on this when we have a high, we have a low, we have a higher high? Just my guess. Could easily come down here, put in a higher low, and then go up to a new higher high and just start ripping. But this thing is basically useless. If you bought into this when it first became public in 2013 and you never took profits, you never sold, you never bought, you're under your acquisition price. So I just assume this thing has performed like shit. It's going to continue performing like shit. All right. And then finally, so Meta, obviously I hate Meta. I think it's trash. And, Mark Zuckerberg is a piece of trash. Although he did kind of rag on Biden a little bit for being a dumbass, but so he went up a notch in my book. So he went from 0 to 1. So he's a 1 out of 10 now. So that being said, Meta, obviously this ascending broadening wedge, quite a bit of resistance at the top here, a couple touches at the bottom. After we broke down from there, I said, look, this looks like crap. We probably lose support. And we did. We came all the way down to 786. That was our target. So, if you were looking to do something with Meta, you could do it from this level. I'm obviously not, I don't have a lot of lines, but Meta is where I draw the line. I have no interest in this whatsoever. But that being said, there's potential, obviously, for a back test at least. Likely goes lower from here. Probably goes, I don't think it's going to go to 0, but probably, let's be real. Is Facebook just going to be the next Snapchat? In many ways it was, right? So, yeah, I think it probably is. I think Facebook is a dying breed. Riddled with fraud. The government hates them. Most of society hates them. Many countries hate them. So in the future, is Facebook going to be in better shape or worse shape than now? I would say probably worse shape. So is this like the peak and Facebook never goes back to this level and it just turns into a dying asset? I would say, the likelihood of that happening is higher now than ever before. We're at 2017 levels. It looks like complete trash. It has obviously just went parabolic, and it has recently confirmed into a bear market on the weekly. Some bullish divergence. Again, we could see a pop from this level. I wouldn't be surprised if we backtested 233 and then went to a new low. And then when we look at the monthly, just complete meltdown. We can see clearly losing this level was bad. We're kind of backtesting it, trying to hang on to it. The next key level I would be looking for to the downside is, essentially just the peak down here. And if we take that out, or the trough, if we take that out, Facebook just looks absolutely horrendous. And then in all reality, we have to basically like fib its entire life cycle and say, okay, you know, what's going on here? Well, we broke down from the 236. That's not good. The 382 is essentially that previous low from 2018. And then after that, you know, we're talking about like sub $100 Facebook. So, you know, is Facebook going to $82? Probably. The real question is, honestly, you know, does it go back to like 189 first? Or does it just go straight to 80, whatever I said, 79, 80 bucks? Who knows? And you're like, well, what if it does go to 80 bucks? Are you buying at $80? No, it's still trash. Still trash. Never buying. And again, there's enough assets and asset classes out there that I can decide I don't like Facebook because they do scummy stuff, and you know, it's not going to hurt me in any way. So let me jump in the chat real quick, and then we will keep on ripping. Take a look at these cryptos. And there's been a big move in crypto. Well, I say big move, but only because it has done nothing for like weeks. So couple percent move, like 5% yesterday or something. But let's just talk about, is this bullish now, or is this just a back test? Does crypto look like China on shorter time frames and it potentially could go bullish from here? Or does it just look like it's getting ready to melt down, and we're just in between meltdowns? Find out in about 3 minutes. What's up, Akis? Good to see you. Hey, so I would like to share my view of this pump. Okay. Akis says, how real of a scenario is that we pump until 13.7? So 7/13, July 13th. So I feel that the CPI is going to be super high, and then another slap coming after the earnings, then rate hike, and probably bad GDP. Well, I'm assuming you're new, Akis, as I don't recognize your name, but also you're basically just saying what I say all the time. I don't know why you picked 7/13 exactly. Okay, I got you. So here's the thing about trying to pick like the CPI data day as the, you know, defining point. I think more realistically, the CPI data is definitely important, but the most important thing realistically is just the end of July, because it's the Fed meeting. We know 100% that things like unemployment and CPI and stuff like that are factored in, and we see moves in the market based on those. But when do we really see? Go back and look at a chart of, you know, crypto or stocks or whatever, and look at those dates of the Fed meetings and the Fed rate hikes, and then look at, are those the inflection points in the markets? And I'm going to, spoiler alert, yes, they are. The inflection points in the market are not the CPI data. They're not the jobs data. They're not those data points, even though they matter. The real inflection points in the market where we decide, are we going bearish from here? Are we going bullish from here? Are we continuing? Are we reversing? The real dates that matter, it's the Fed funds meeting, Fed funds, you know, rates, hikes, etc. So in my opinion, it's the Fed meetings that we're going by. So, you know, you say 7/13, sure, that could be an inflection point. I think more realistically, the markets have, I posted it up in our private Discord. I posted up the hourglass, and I've been talking about it lately. In my opinion, since the end of the half, just like we said in advance, we expected a bullish, you know, relief rally in all these markets that have been getting wrecked. In my opinion, that's what we're seeing right now. Now, is it going to be, you know, 2-week rally to what you're saying, the CPI data, or is it going to be a, you know, 3 or 4 week rally into what I'm saying, the Fed funds rate? I mean, what's the difference? A week? I don't know. You don't know. But I would say probably the Fed meeting is the real inflection point. Doesn't mean we don't top out before then. Doesn't mean we don't run up after we get a 75 basis point hike and then sell off again like we did the last 2 times. We don't know exactly what's going to happen, but I would say, you know, give or take, that week is the most important time. So, but yes, you basically just said the same thing I've been saying for months. So Cool Sheet says, hey bro, Bitcoin and market doing an exit pump, I see. We'll be shorting Bitcoin 28K if lucky. Yeah, I don't know if we get that high. Honestly, it could go either way, but it's definitely an area to look at. Calma Betty says straight to the moon. with some thick sarcasm. X Angel, what's up? Says hello to you. So yeah, let's keep going here. Say what's up in the chat if you have not already. Make sure to smash the like button. If you please don't message me on TradingView, or if you do message me on TradingView and then I say, hey, just message me, just email me, please. Please don't message me through TradingView. They have like stupid rules about what's allowed to be said, discussed, etc. You can't post links. I can't post emails, whatever. So for the people that have been messaging me in TradingView and I'm like, just email me, and then you're like, what's your email? If you can't figure it out, I'm sorry, you're just not ready. You're not ready to be a part of the community. So, and I'm not being a mean to you specifically. The couple of people that have recently messaged me, I'm just being real. Okay. If you can't figure out how to get a hold of my email, I don't know how to help you. Just go. I mean, no, that's it. That's just the barrier to entry to email me is figuring out what my publicly posted email is all over the internet. If you can't figure that out, you're just not ready. So that being said, Bitcoin futures chart. Take a look at this. Obviously, not a ton going on here. We did exactly what I said, of course, obviously. So we put in the hard buy signal, all green histograms, bullish divergence off the points, got above the 8. We back tested the 21. That's exactly where we topped out at. That was exactly what we were expecting. If we go down to a shorter time frame, which I don't often do, what does it look like on the shorter time frame? Well, 821 cross back to the upside. We're trying to back test the 200 exponential or simple. We'll look at the spot market chart too and talk about that a little bit. So realistically, if the CME is in charge and we look at the 4-hour chart, we took out those previous highs. Likelihood is that we continue to the upside and we back test something like 24,300 roughly. Reversion to the mean. And then what happens after that? Probably rejection and we go lower. What if we consolidate here and then go higher? Well, we could start looking at 4-hour bull market, bull trend, potentially resuming, and then going higher. And then we can look at the back test of the daily, etc. But we did come all the way from the bearish control zone back to the bullish control zone, and we're seeing a hard sell. So what does it look like happening? It looks like it's kind of topping out right now. So we'll see what happens. Still looks okay on the shorter time frames. On the daily time frame, today's going to be a big deal. We closed yesterday above the 8. We back tested the 21. So if we can close today above 22.5, it looks likely that we get a back test up to like 28K. But then again, for me, that's just going to be what? A gap fill, a retest of what was support acting as resistance, and then entry for short position. I mean, you said it, bro. You said it. Cool sheet. I mean, you know the layout, obviously. So that being said, that's what I'm waiting and looking at. When we look at the weekly, what do we see here? Well, exactly what we talked about. The back test of a 200 simple, potentially back test of a 200 exponential as high as 23.8. Wait a minute. That was just an area we talked about. That's crazy. So, a lot of confluence on these charts right now. A lot of people trying to get bullish right now. When we look at the longer time frame charts, we don't see any of that divergence. When we look at what's going on in the weekly chart, we see it's doing something it's never done before. When we look at the monthly chart, we have crossed the downside. Looks terrible. Nothing has changed for me. I mean, we literally talked about and positioned for this, essentially what I'm calling a dead cat bounce. So that being said, on the spot market Bitstamp chart, obviously bullish divergence. We're able to close back above the 8. Now we're back above the 21. Obviously got that back test. If we switch down to the 4-hour real quick, we can get a little clearer of what's taking place here. Basically, this was our big push back up to like that 22.7 retest of the 4-hour 200 exponential and simple. We still have momentum in our favor. We are technically still in the bullish control zone. I would expect one more push back up here to like 22.6 at least, and then maybe a top out from there. I don't think we'll get this close to the moving average, not touch it, and then just roll over. That's just my opinion, though. As far as I'm concerned right now, this is basically a push up and then retest of support. This area was resistance, should act as support. As long as we're above that, it looks okay. So if we're above like 21K, I think Bitcoin looks okay on shorter time frames. For a move back up to like 22.6. But realistically, we'll have to see what happens. I mean, is this just going to turn out doing this exact same thing again, where we just go sideways, 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 eventually backtest, meltdown, sideways, 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 eventually backtest, meltdown? I mean, seems likely. Here we kind of touched them both and then backtested and then melted down? I mean, it seems likely. Is this just going to be another bearish reset before we go much lower? Seems likely. You know, we don't know for sure, obviously, but, you know, here we were very close to crossing 821 back to the upside and then potentially getting that big move back up to 40K. Didn't happen. Meltdown instead. So, you know, we get closer. Maybe we get the back test up to 28K. Maybe we get it higher to 34K. Doesn't seem as likely, but obviously possible. Obviously is possible. Zooming out here and taking a look at the weekly. So again, this is just our back test. Obviously, we did something we've never done before. Close below 200 simple. 200 exponential is already red. 200 simple is pretty flat. We back tested it perfectly and got rejected. You know, we're in the bearish control zone. So you're like, oh, so this is a buying opportunity because we're at the bottom of the range. Maybe. Or maybe the bears are in control and the bulls are dead. I mean, that's what it's really telling us. The argument or like mentality that whenever we're at the bottom of the range, we should buy, and whenever at the top of the range, we should sell. I mean, that's okay, except for if, you know, here you bought and then you sold right here, and then it just went higher and higher and higher and higher and higher. So you're like, oh man, I just sold and took some massive profits at $10,000. And then you're like, I'm a genius, until we're at $12,000, until we're at $60,000. And then you're like, okay, that sucks. So is that reliable? I mean, clearly in a bull trend here, so we don't want to sell in the bull trend. We want to buy the dip. And then, you know, starting to flip between bull, bear, bull. And now we see bear, bear. So now we're in a bear trend. So do we want to buy the dips in the bear trend? No, obviously not. That's what morons do. That's what hodlers do. That's what dollar cost averagers do. Dollar cost averagers don't need to look at technical analysis or fundamental analysis, because they just buy methodically and pray to God that eventually we just always put in new highs. I mean, that's like, if you're learning about TA or researching it or trying to become like a trader or investor or whatever, you don't need to learn anything for dollar cost averaging. So you wouldn't even be here. So that being said, we're not buying dips in a bear market. We're selling rips. So that's why we're looking for the back test for a selling point to enter into a new short to go lower. So do I think we should buy at the bottom of the range because we're in the bearish control zone? No, not at all. If anything, we buy when we're exiting the range, as the bears are in control, then they're losing control. And then it's like, oh, okay, the bears are losing control temporarily. Now we could be interested. Short time. So 821 cross on the monthly. Still very, very bearish. The histogram the slope line has just flipped red. The histogram is below the slope line, and now we're below the zero line. So the TDMACD is maximum bearish right now. The Jewel Thief obviously left the bullish control zone, hard sell signal. Stokes are angled to the downside and accelerating to the downside, and the knife is below the blue stochastic. So maximum bearish on the monthly. And then the 821 have crossed to the downside. And because this asset is not old enough, we don't actually have a 200 exponential monthly moving average to reference. So again, maximum bearish. Obviously, knowing where the 200 exponential simple would be roughly, that is still bullish for now. So on Bitcoin's whole entire life cycle, the 200s would still technically be bullish. But every other indicator as of now is bearish. Yep. But again, doesn't mean now is the time to get bearish. Got to get bearish at the right times and bullish at the right times. And if you're off by even a little bit, probably screwed. So ETH backtesting for what looks like this W double bottom. Obviously have the trade setup in play from the bottom of the range to 382 for the potential backtest to the 236. 76% move to the upside. We're a decent ways into it now. What are we, about 20% up from there? 15. So looks okay. Getting back above the 821 is definitely the first step. Looks okay for now. Again, we put up a bunch of these bullish setups. I didn't want to get like overly bullish, but you know, we got to trust the market when it's telling us something. So Bitcoin dominance chart on the weekly, the triple bullish divergence, we broke out of the top of the channel, got a nice little push up, back tested. It didn't hold. It kind of came lower. The most important thing was higher lows on the green trend line, and now we see Bitcoin strengthening up here. It had a little pump these last few days, and the altcoins really didn't. A couple did. Ethereum looked okay. A couple other trash coins looked okay, but this was more of a Bitcoin pump. So we'll see. Getting back outside of that range and closing above it, obviously good. I do expect continuation to the upside. I am bullish on Bitcoin dominance. Total market cap on the weekly, holding support at 200 simple. Looks okay. Again, closing above these previous two candles is definitely a good sign. And we'd likely get a retest of the 8 of the 200 exponential, a back test of the 1.07 trillion mark. So that would be good if it goes back above a trillion. But obviously this chart does not look great. But we would expect to find support at this level. All right, so I think I got all the cryptos that were requested on here. So usual suspects, really. So Avalanche very close to the 821, confirming bullish on the daily. You know, and starting to look for like potential back tests of like 2290, maybe like $30, building up a little momentum. Looking slightly better, Solana with the 821 cross already confirmed to the upside. A little weaker price action though. Breaking above 42 would basically give us a breakout of that neckline. And then we could start looking at some of these other key levels. Polkadot putting in consistently lower lows. Definitely underperforming for now. There is potential for some kind of setup like this to play out. Basically, if we could break above that resistance, that descending resistance, we could likely see a much higher short-term target, I would say. Is it going to get all the way back up there? I mean, probably not, but there's definitely some potential for a decent like back test. We'll have to see. It's tough to chart these trash bag altcoins because I don't know like when they got listed on like what exchange. I mean, this looks pretty realistic though. Obviously we see some pretty clear reactions here. So I mean, the real target would be probably the 0.5, then maybe the 382. I mean, I wouldn't get too excited on this one realistically. 48% upside or 116% upside for the back test of the 382. Full disclosure, Polkadot is obviously trash. I mean, it's a crypto project that's definitely trash. That being said, I do have a open position currently on Polkadot. Basically, if we take out the low on a daily close, I'm out of here with it's like slightly less than 10% stop loss with those two targets in mind. First, the 0.5, which is a 45% upside target, which gives us about a 5-to-1 risk-reward ratio. Probably fails and goes straight to zero. This will probably be the next implosion. And, you know, if you try to invest in, purchase, or speculate on this said cryptocurrency, you will lose all of the money you put into it. Probably by the end of the week. It's definitely on its way to zero. But in the meantime, it could go up 45% or potentially 116%, giving us risk-reward ratio of like 5-to-1 and 12-to-1. Something obviously I am comfortable taking advantage of, or just giving away 10% of my money for no reason. So that being said, probably goes to zero, but some nice trade setups in here. All cryptos probably going to zero. I mean, there maybe be an outlier. If you pick like at random 100 cryptos out of like the whatever, how many like thousands there are. If we pick 10 at random, probably all 10 of them go to zero. So basic attention token. So it has the 821 cross back to the upside. It's starting to look like it's carving out a bottom here, breaking above those previous supports, back testing, or resistance back testing as support. Looks okay. Looks like it wants to come up here to like 60 cents. Again, probably just going to zero. Maybe not this one because it actually does something. Like 43% move back to the upside. So again, small position on this one. We'll see what happens. Definitely going to be trailing my stop on this bad boy because I'm not going to wait until it puts in a new low at like 28 cents before I get back out. Just if we come back down to my entry price, I'm getting back out of this one. So if it drops below like 38 cents, I'm back out of this, losing momentum. But as long as we're in it for now, it seems probable that if this area holds, we basically backtest like 42. So we'll see. I think we had a, sorry, I did my updates and all that stuff, and I can never remember what exchange we were like previously on. So like I just load up a random chart and there goes like all my drawing tools. But I mean, I do the same thing over and over again. So you're like, oh, all my charts got deleted. You're like, oh, I'll just practice drawing the same chart over and over again. So that being said, we bounced the 618 pretty perfectly. As long as we're above that 0.5, as long as we're above the 8 and 21, I still see our target being like that 382. Now, I would not get excited about these random crypto projects overperforming. I would assume that they're all going to underperform. Percentage-wise, it could be nice though. So that's what we're looking for at 382, like roughly 60 cents. Backtest before we go lower, likely. So Chainlink, I mean, this thing looks terrible. It looks so terrible. What do we want to do for Chainlink? We want to do a channel. Oh man, I don't know. This thing looks. I mean, that looks okay. That looks okay. I mean, this is probably what I would just be paying attention to. Keep it pretty simple. You know, we have this heartline resistance. We have this, you know, channel support right here. This is obviously not like ideal, but we can see kind of like wick below that support there. Bounced it here, moves up, comes back, wicks below it a little bit. So it looks like it's squeezing into this range. We know obviously typically what happens with these descending patterns like this, we get a breakout. So realistically, we probably go to like 10 bucks, which is like a 50% move. If we break to the upside, you know, it probably goes to zero. But 50% move to the upside. And again, pretty tight stop on this one since we're just at the lows because nobody wants Chainlink, obviously. It's obviously trash because no one's buying it. Even though crypto's trying to have a move to the upside, Chainlink is just hanging out at the lows, just, you know, hanging out, waiting to go to zero. It just hasn't had an opportunity yet. So I think on a long enough time frame, Chainlink probably goes to zero. But in the meantime, we might get that 50% move back to the upside. So 16% stop loss if we take out the low. That's kind of brutal. I think realistically, if you were going to look at this, you have to look at like 585 as your line in the sand. Entry where we're at right now, roughly around here. Or if we break out and just kind of hang out on the breakout. And then you can look at a 47% potential move to the upside with 8.5% stop loss for a 5 point, roughly 6 to 1 risk reward ratio. Look, I wouldn't get overly bullish on these cryptos. And I literally would like, you know, pull up a graphic of one of those little sand timers. And the sand is just like coming out. There's like a couple grains left because we're literally counting the days, in my opinion. I mean, if my boy in the chat was right, you know, maybe it's the CPI data, and in which case you got like a week. And if I'm right, you know, it's Powell opening up his mouth. We'll see. But I mean, either way, you know, we're talking about like a week or two of potential before I expect much further downside in these markets. Matic next. Backtesting resistance. Looks okay. Really needs to just break above like 60 plus cents. And then likely, I mean, this thing could actually run a little bit. I mean, really like between 60 and 70 cents. I would expect 70 to act as decent resistance. So from where we're at right now, there's a little bit of meat on the bone to get to the 618. If we can break through the 618, the real trade is to backtest the 0.5. So, I mean, there's not going to be a good setup from where we're at right now, but 20% into momentum, into resistance, and 56% backtest the 0.5. It's possible. I don't know. This is a tough one because there's not really a good setup. Because realistically, your stop needs to be if we lose that level, and we're already 21, that's 21% down. So there's no real like potential entry. And if you wait for like the safety trade and get back up to the 618, there's only 30% left meat on the bone, and you probably wasted a bunch of that like time that's ticking down. So all right, and we're gonna finish up with a couple of commodities today. So we have gold, obviously broke down, looks absolutely terrible. Dead cat bouncing off support. Weekly close is gonna look disgusting, as expected, as predicted, as discussed. Guaranteed though? No, of course not. Nothing's guaranteed in this world. But, historically speaking, TA a little better than a coin flip. Let's be real. Seems very likely that we get a retest of 1680 or so in the next couple weeks or so. Entering the bearish control zone. And just look at the disgustingness that is the monthly chart. Still 3 weeks to go, but starting to look awful lot like this. And when I say starting to look, I mean we've literally been comparing this peak to this peak for 2 years. So we're 2 years in, and the chart's still doing exactly what we said. So, but I get it though. But the fundamentals, the gold standard. Look, anybody that says we're going to go back on a gold standard, anyone that says, hey, we're probably going to go on a gold standard into the future, they could be right. There's like a 1% chance that happens in the future. So they could be right. But let's just assume until we go back on a gold standard that anybody calling for a gold standard is a fucking moron and has probably been saying it for 30 years and probably will just be wrong for another 30 years. So we'll just broadly just paint everyone with a brush that says that the world is going to go back on a gold standard or said country is going back on a gold standard. Let's just assume those people are absolute fucking morons and don't understand how politics and the monetary system works. Let's just assume that that's true until they're proven right, which we'll all probably be dead by the time that happens because it will never happen. Part of the problem with the gold standard is that stupid ass governments and horrible ass monetary and fiscal policy doesn't work when you have sound money. So why would the people that get all the money and make all the money and get to spend all the money on dumbass shit and funnel it into their own pockets and other people's pockets, why would they want sound money? So they wouldn't, obviously, because then they can't manipulate it. So they wouldn't want sound money. And who's in charge of the money? Who's in charge of the currency or, the politics, the laws, the fiscal and monetary policies? Who's in charge? Oh, the same people? Oh, okay. So thinking that the morons that are abusing the system, that's like literally saying, oh, I'm in a relationship and my spouse beats the shit out of me. Regularly, just beats the shit out of me, abuses me, takes advantage of me, and is just an overall scumbag piece of shit, okay? But also, this person is great and they're just going to do the right thing eventually. And then once they do the right thing, things are just going to be awesome and great. That's like saying that you think we're going back onto a gold standard. You're in an abusive relationship. Your spouse, aka, the Federal Reserve or the, central banks and, the government, aka, the Nancy Pelosi's and the sliding Bidens and all these other scumbags around the world, call it Boris, whoever. You think that these scumbag, abusive pieces of shit that have been literally taking advantage of the masses for hundreds of years, not these specific people, but, the chain of command. You think those people are going to suddenly, the abuser is suddenly just going to be a good person? That just shows you how fucked up your brain is and that you're suffering from derangement syndrome. But, I could be wrong, though. But let's just assume that I'm right and the same thing that's been happening for 50, 100, 1,000, multiple thousands of years just continues to happen. We'll just assume that the trend continues happening where the people in charge are shitty and don't want fiscal and monetary responsibility. We'll just assume that because that's how it's always been. And then if I'm wrong, I'll gladly admit it. But, you'll probably be digging up my bones 1,000 years into the future before that ever happens. So I like my odds. Now, that being said, this is our breakdown on gold. This is our back test and then meltdown. Underneath is a slope line. Well, it's still blue. This is our breakdown on gold, our back test, and then meltdown while it's still underneath and it's blue. And that was our top right here, the signature meltdown. That was our potential top right here, signature meltdown. So do I have to be right? No, I don't have to be right. But does a gold standard seem likely based on what we just discussed? And does this chart also look like shit? Yes and yes. Yes and yes. Okay, so that being said, gold standard in the future, because real money, no. Don't be dumb. Don't be dumb. Not you guys, but just everyone else. So that being said, silver obviously looks like trash. We've been calling for silver to be a teenager, and obviously it is back in the teens again. 19, congratulations, silver, on your meltdown. Your chart looks like trash. All of the gorillas have been decapitated. The silverbacks are dead. I'm sure they are literally crying. A matter of fact, I have to like go search out some of the silver crowd because it's been so long since I've seen any of their videos, but they're always like really, really funny because no matter what happens, they still say the same thing. They're like, well, because the supply-demand dynamics and the silver and the manipulation and who gives a shit? Who gives a shit? Let's make money, not talk about fucking fundamentals of silver. Get the fuck out of here. Oh, and then the monthly chart, looks like just absolutely atrocious. Let's be real. Okay, let's look back here at what took place from, we could go back. Let's go back to like the bull run that started in 1944. Now, I know normal people don't do this because they're looking at like 6 hour, or 3 hour or 1 hour or 15-minute charts, maybe a daily if you're lucky. But they obviously don't look at monthly charts. No one looks at what happened in the 1900s or nobody gives a shit about any of that because recency bias. Well, let's look at our silver chart. We went into a bull run in 1940s and it went parabolic, okay? And then what happens at the end of the bull run when it's starting to run out and it's getting tired and it's getting ready to go lower? The 200 simple crosses above the 200 exponential, shows exhaustion. The trend is running out. That took place here in 1987 at $6.85. What happened since then? Started back into another bull run, came back up, put in, essentially same high, higher high, same high, whatever you want to call it. Another bull run. And then what happened here? That was in 2011. That was our double top for the potential macro cup and handle that we've been looking at, which that's okay. It's still intact. That's fine. I'm not being mean to silver. We're just talking about what the chart's telling us. We're just looking at the breadcrumbs, seeing what the market's saying. Well, look, 200 simple has crossed above the 200 exponential, and now we're putting in a lower high and back testing the 200 simple, getting ready to back test the 200 exponential. Let's see what happened over here when that happened. Okay, the back test, it didn't act as support, and then we went way lower after that, and we confirmed into a monthly bear mark. Wait a minute. So I don't know. It's hard for me to be bullish right now when it looks like we're basically just doing the same kind of thing before we go into like a multi-decade bear market. Now, does it have to happen? No, but it doesn't look good for silver. But also supply chain and the dynamics and the supply and demand and the electrification of the future and the energy and the batteries, and I don't know. I don't know about the fundamental. I can't tell you why the silver chart looks like shit. All I can tell you is that it does. So gold silver ratio, obviously breaking out, confirming into a bull run. No surprise. We hit my target. It's been a long time coming. We did it. We made it to the end. We don't know what's going to happen. Maybe it continues. Maybe reverses. ACB, pot stocks, still looking like trash. I told you I took some entries at these levels, but I'm fully prepared to hold for a long time. Realistically, I've been pretty clear about how I feel about pot stocks. They obviously are the worst stocks ever, but they have some potential. Canopy growth, again, same thing. So uranium stocks. Okay, so CCJ back testing, looks like it wants to go lower. Could potentially pop higher. URA, again, new lows, trying to back test, could potentially pop higher. We'll see what happens. Did I honestly not even pull up the chart? God, which one did I enter? Hang on one second. I can't even remember which one it was. Whatever. I'm not going to do it right this second. I don't feel like logging in. So yeah, we'll look at them some more in the near future. Took a just quick little scalp trade currently open on, man, which one was it? I'll have to check. I'll post it up in Discord afterwards. But yeah, that being said, for a potential pop back up, if we see some bullish price action, I'm not too bullish at the moment, but we did hit some key support levels, and they're holding for now. Starting to see some signs of exhaustion. Does not mean that I'm bullish on these. Just for like a quick little back test. I think it was like a 20-something% scalp that I was looking for. So, but yeah, I'll post that up in the Discord. But anyway, that's it for today. Gonna go ahead and wrap it up there. Gonna jump in chat real quick as it is 1 p.m. or a little over 2 hours in. Jump back up here real quick. Cool Sheet says, "Hey bro, Bitcoin and market doing an exit." Oh, that was the old one. Straight to the moon. Big D says, "Listening to Crypto Trend Trader calling the entire market trash and disgusting. Wouldn't miss it for anything." Yeah, I mean, it's not my choice, man. I would love if the market looked good, but everything just looks like crap all the time. There is one good chart in all of existence, though, and we know what chart that is. It's the DXY. The same one that everybody was saying was trash forever. And honestly, TNX looking pretty thick and juicy at this point in time too. So we'll see what happens here. Definitely some potential. I'd be real careful for like short-term bearish divergence developing and rejection off of key levels, like for instance, 4-hour 200 moving averages. But realistically, it looks like we have maybe another like week or two of a bullish pump on our hands. Potentially, could fail. Could overperform. We don't know, but definitely looks like there's some legs for at least like these short-term rallies. But obviously, none of this financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. It is 1:10 p.m. Eastern Standard Time on July 8th, 2022. And that is it for our Friday morning, or now it's Friday afternoon, market wrap-up. If you'd like to catch our streams in the future, obviously stream every single Sunday night and every single Wednesday night from 8 p.m. Eastern Standard Time till about 10 or 11 p.m. Eastern Standard Time. And of course, every Friday from 11 a.m. till 1 p.m. Thanks to our members who show their support and make this additional stream possible. Keep your eye out for some static videos have coming. Lots and lots of old videos if you haven't checked those out. Obviously, plenty of free resources, including all of the indicators except for the TJD Master and the updated version of the Jewel Thief are available absolutely free. If you'd like to get a hold of those, join the Discord group and a group of like-minded individuals that like to clown, post memes, have fun, and learn stuff. And of course, prosper in these markets, regardless of if they all look like trash or look good. You can reach out to me at my email. If you can't figure out how to get my email, I honestly can't help you. You have to focus or maybe hire a woman. They're pretty good detectives. I'm sure they can source it out. But that being said, going to wrap it up there. So that is it for today. Remember, it's not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. Everybody have a great weekend. Protect your principal. Guard that capital. Lock in those gains every single chance you get and realize some of those gains into real money. Spend that money and enjoy your victories, however small or large they are. But that being said, Crypto Trend Trader, and I'm out of here. Peace.